When you think of the system, you can think of the sensitive indicators, the 22 market force recognition indicators. Or you can think of the 3 steps, the patterns, the conditions, and the signals that make up the formula to find high probability trades. You could think of the powers within the system. That's basically the sensitive indicators, the formula, and then the procedures power. And when I was contemplating putting this system together, I knew I wanted to have the ability to see market movements. I wanted to know when things were going to move. I wanted to recognize when things were going to move. And when you continually analyze opportunities between the indicators and the price movements that result from those indicator lines or patterns, you gain a level of knowledge about how things are going to move next day. And this is powerful knowledge. It's powerful because you have the ability to recognize it. One of the other things that you may not think of, and that is the radar screen. And we've in the interest of making this system completely ready to go and making it as powerful as we possibly could, we created 8 master radar screens for anyone to use. And those 2 of those are displayed on the monitor right now. The 5 columns in the red and green right here, this is all one indicator. Those 5 columns, by the way, if you're not familiar with how the indicators work, you can have 30 indicators on the radar screen, but each indicator can have many columns to them. I use the symbol column, the interval column, because I always want to know what interval I'm on, because I switch back and forth a lot, and if you're trading you may do as well, but you need to know which interval you're on the radar screen. The last is basically the last value trade that the stock traded at, and then the shares column is basically tells us how many shares that you can trade in the next time you enter a position. That is when you go into the development environment and you open that up, you'll find a line in there that can be changed. I normally have that set at about $10,000, but there's much more sophisticated ways to do this column. You can have it attached right to your account number, and it'll print out exactly how many trades you can make versus what's in your account. And that obviously you don't want to trade your whole account, but it will give you knowledge. Also, if you had that set up, it would give you knowledge that you only had so many trades left on your second or third trade of the day, or the available funds basically is what I'm talking about. But I like this better. I look at it as though if I'm going to pull the trigger, I'm going to use about $10,000 worth of money, and whatever it buys me, that's what it buys me. Each of us are different. You use whatever setting you want, but that's what I personally use. The next indicator is basically the 7 short-term trend lines. There are only 5 columns, and the reason there's only 5 is because the left column the trend trio column is basically trend yellow, And when yellow goes up, pink and blue also go up. When one moves one direction, the other two move the same direction. So only one column was needed, and we know which way the trio is. We also know if it's above or under 0. When you're looking at this, at the 7 short-term trend lines, the boxes on the short-term trend lines tell us that the indicator line is down. The green box tells us that the indicator line is going up. The text, the white text, for example, tells us that the indicator line is above 0, and the red text tells us that the indicator line is under 0. White meaning, in my mind, I think clouds in the sky, so that's going up. All right, that's how the 7 short-term trend lines indicator works. That's powerful information, because at a glance, if you're seeing something that might have a possible movement to it over here in the divergent chart, because this is my primary reason for this video is the divergent indicator, the master divergent indicator chart. And that is basically what you see right there that I just clicked on and off. That when you see this, excuse me, over on the right I have 2 columns, this one here and this one here. These two are just two columns, Zip Blue, excuse me, Zip Blue and Zip Zion. They're 2 out of the 22 market force recognition indicator. These are separate indicators. One, you can see when I click on the header, only 1 column changes. When I click on the header, only 1 column changes. Whereas when I click on this one over here on the top line, all of them change that are in the indicator. I can do them separately underneath the top line, but the computer looks at this indicator right there as one indicator, even though it has a dozen columns or whatever it has. Now, this is one of the most interesting and the most powerful radar screen indicators that we have. If you're not aware of it, divergence happens quite a bit in gaps or strong uptrend movements. But primarily, most of us look at it in the way of gaps. Also, if you're not familiar with it, the whole system is built on reversal recognition identification. And this is specifically geared towards cycle tops and cycle bottoms. With that in mind, we then try to identify those cycle tops or those cycle bottoms that have strength. And there are 2 types of strength. Line indicator strength, line length indicator strength, and divergent strength. Divergent being when one indicator says it's going up and another indicator says it's going down. We systematically look at pairs. For example, zip red and zip gray are paired together. We see if we identify if those 2 are in a divergent situation. The indicator itself over here in this column here, we have zip red that's divergent with zip gray. Zip yellow is divergent with zip blue. Zip green is divergent with zip Zion. These are the 2 buyers in, buyers out indicators, as you know, or may not know, but that's what they are. Here's power pink is divergent with power blue. Those are paired together. Those are deep cycle indicators also. Then you have power yellow and power white. You have trend red that's divergent with power red. Now these are big 3 indicators. Trend red is the best indicator in the entire system for the amount of information that it gives us. And when we have trend red and power red and swing Zion, those are the big 3. If they're all in a bottom pattern, like for example, they're all in a low angle down pattern, or maybe they're all in a BOC pattern, that tells us a lot, because the combined forces of those 3 indicators we've just discovered, I mean, it was a long time ago, but we just discovered that those three together gave us a lot of information as far as price direction goes and the strength that it goes at. Oftentimes when those three are moving in the same way with the same shape patterns, you can get multi-day trends. The next one is trend red is divergent with trend green, and this one here, you know that when trend red crosses over trend green, you're in an uptrend, and when red stays above green, traveling above green and going up, you're in that uptrend, and you can stay in a trade until trend red no longer goes up. Or what oftentimes happens, it goes into a low angle up, which then is indicative of the last day of the uptrend, and it only went up a little bit that day, and you can of course get out, which is great. And so the opposite is true. When trend red crosses under trend green, you're starting a downtrend. Here trend red is divergent with trend gray. We often see trend red and green going up, maybe up, and gray going down. So basically it amounts to those three, and usually red and green are going the same direction. But when trend red and trend gray are opposite, that is a divergent situation, and you'll oftentimes see strong movements, especially when gray is above zero. Price red is divergent with price green here. Basically what we're talking about there is a crossover situation. In other words, price red was highest, they both went down, and now price red is lowest. So it has crossed under trend green at the same time when they went down. So we treat that as a divergent condition because of the crossover. And the reason for that is they are price barometers, and they are coded very close to one another. And as a result of the crossover, it creates the divergent move, and you will typically see significant activity after that crossover. But like so many times with divergence, remember divergence, I mean, the vast majority of the time it happens the next day. But it also, I don't know what the percentage is. I'm going to just kind of guess that maybe 20% of the time divergent situations occur on the second day and even the third day after the original divergent move. So there's a lot of knowledge or a lot of information that needs to be transferred in when it comes to divergence. But it's one of the two ways that we identify strength in a movement. And because now, for example, if you went to the original default indicators at TradeStation, you wouldn't get anywhere near the amount of divergence that we get in the system. And that's because of the sensitive indicators and their ability to pick up tiny market force changes or market pressure changes. And when they pick up those things, one will react differently versus the other, which gives us the divergence that we then recognize the change is taking place, even though those individuals using default indicators have no idea what's going on. The next one is swing pink is divergent with swing Zion. And then over here on the last one, and we don't see this very often at all, and this is power pink and blue are divergent with power white and yellow. If you look at this column, those two yellow bars right there on these two indicators are the only two in the whole column, and you don't see paired divergence very often. That's blue and pink going up, and blue and white and power white and yellow going down, or it could be the other way. On the box color alerts, if you go to the box color alerts, you will find you will find a page on every single master radar screen indicator, giving you the code colors for what's happening. Just so that I make you aware of it, in the divergence situation, we look at the first name. In other words, in this case right here, trend red is at the top and power red is at the bottom. So when I say that trend red is divergent with with power red, I am saying that trend red is up and power red is down, and that produces a yellow box. If, for example, you get a dark yellow box like over here, that dark yellow box has the second name. So in other words, power pink and blue are up and power Zion is down. So it's when you look at the code, that's obvious, but it's a first name, second name basis. Excuse me. The first name is at the top, the second name is at the bottom, and this goes through all the way down. When you have a blue box, for example, you have the blue box with a white text is a crossover. So in this case here in this column, this second indicator is telling us that power yellow crossed over power white. And so we end up with a blue box right here. If we get a light blue box, it's a cross under, but you're obviously not going to get both at the same time. The cross under is telling us that we're obviously, or excuse me, when you get a blue box with a white text, it's crossing over. Logically, when you think about it, it's also telling you that it's going up. And typically both of them are going up. So sometimes you need to think through what you also see, or the multiple pieces of information you can capture from a crossover. Because over means up and under means down. So this is the divergent conditions that we have identified. These are the major ones that we have. Keep in mind, you can add a particular divergent pair to this list if you want. All you have to do is go into the development environment, look up this indicator, and look at the code. And you can see how we wrote the code, and you can add two indicators. Like maybe you want to do, swing Zion and zip green. Whatever those two pairs are, you can throw them onto this list and build your own. That's the whole idea behind this thing. These ones that we have on this list are major divergent conditions that we often find in gaps that occur when divergent situations do occur. Now, if you look at the rest of these, look at the indicator itself. Almost in this case here, I've got it clicked on, so everything is white. When you look at it like this, everything is black. And so all of the black boxes, all of those black box alerts are telling you that there is no divergence occurring in any of those indicators with the black boxes, at least that type of divergence in that column. And so when you're looking at one and you see one, maybe I can find something here. There's not really a lot of, or not really a significant amount in any of them, but this one here, above this line right here, there is 1, 2, 3, 4, 5, 6, 7 different indicators that are divergent. And I've seen many gaps with 4 or 5 in divergence. And so everything is relative to the degree of which indicators are divergent and the number that are divergent. The more divergence you get, typically, the greater the gap. Now, these are obviously not all gaps, because you remember, you have to have the required conditions for each of the 3 patterns before you end up with a gap. Example, you can get a situation that has 15 or even 18 indicators, identical indicators in one pattern, but it does not have one of the 6 down touches, or it doesn't have the proximity, location, and shape, proximity shape patterns in what we would identify as a normal position based on that specific pattern. And so what's more obvious is the down touch. If you don't have the down touch, you don't have a gap. And so what I'm saying is that if you get 18 indicators without a down touch, you've likely got identified a really strong green candle the next day, or an uptrend. And I'm assuming now that that pattern that you're looking at is off of the pattern types up, which indicates the price is going to go up, and not on the pattern types down. Those are all, everything's different depending on which pattern, which 3 patterns you're looking at. Excuse me, I hope I didn't confuse you there. Yeah, those patterns that have names to them is what I was driving at. For example, a red spike is zip red going down under 50 and zip yellow going down and above 50. It is a reversal pattern like all the patterns in the system, and when it's going down, it reverses and goes back up. By name, that's a red spike. A red peak is zip red up above 50 and zip yellow up and under 50. And that's a reversal pattern going down the next day. And so when it comes to shape patterns, like the identical shapes, those can be both the same direction. But what's going to happen is you're going to identify with key indicators that tell us which way the gap is going to go. That can be something as simple as one of those, something as simple as zip Zion highest or zip Zion lowest. It could be the price lines that are way up high, like 145 or 149. They're going to gap and go down. So there's always going to be a key element for you to see which way the gap is going to go just by examining the evidence. But gaps, when you're talking about the requirement for the gaps, remember there's 3 types of conditions. You have the conditions required to make it a pattern. Like those definitions that I described, the red peaks and the red spikes. You need to have both yellow and red, zip red and yellow, going up for a peak, and you want the red above 50 and the yellow under 50. If you've heard me talk about that particular pattern, you know that those 2 have great flexibility. They're not like a normal pattern, because you can have zip red under 35 and zip yellow under that, and it'll still go down the next day. So it's not that above 50 line is not set in concrete. But the point that I'm trying to make is that you can identify, even though you have shaped patterns, like for example, you have 18 identical indicators that are the same, and they're going in and next day is going to be a gap up. You can have 18 identical indicators, and the next day you're going to have a gap down. there are key shapes that almost always go up. Like, for example, a right leg W almost always goes up. I mean, I can sometimes when you have like 9 right leg W's higher going up and 8 right leg W's lower going and 8 right leg W's that are lower, you then have even though you have a group that is higher and a group that is lower, typically the next day will go up. Once in a great while, you may have a stagnant day where the price hardly even moves. If you get caught in one of those and you're in a gap situation, just hold on, because it's more than likely going to gap significantly the following day. Because remember, when you're talking about divergence, the vast majority of the time, I'm gonna say maybe I haven't calculated that, but just based on experience, I'm guessing that about 70 to 80% of the time, divergent moves go the next day, but they will go 1 or 2 days after that as well. Or excuse me, the major price movement will take place 1 or 2 days after the divergent move occurred. So this is powerful information to be able to look at a radar screen and see. You don't have to, I mean, if you've tried to look at a chart and see if a line is a BOC higher or a BOC lower pattern, believe me, most of you can instantly tell that that's going to be very time consuming. What these charts do is they give you instant response. If you've got a really good one that you picked up on the scanner and it looks like it's great, just type it in on the radar screen and see what it looks like. You can instantly tell it's measured out. Do you have BOC higher or do you have BOC lowers? Do you have 2-day BOC patterns? Whatever it is, you're going to pick it up. And that reminds me, when you have a green, for example, a BOC pattern is green because it tells us, the color tells us we're going to go up. When you get a dark green color, that's a BOC 2-day pattern. So what I'm saying is that normal green and dark green are the same direction. And when you're thinking of them on the chart, think of greens as one response, and other colors as one response. That's the theme behind setting up the color codes within the various master charts in the radar screen. So I kid you not, the ability to be quick, the ability to analyze 200 or 300 indicators in just a matter of several minutes is there. You can take 2 or 3 monitors and stretch that thing across 3 monitors, and you could have 5 or 6 of those. You could put the location master pattern there, the shape master pattern, the divergent master pattern, the down touch and the up touch master patterns, the 7 short-term trend line master patterns. You could put all of those on the 3 monitors and look at them all at the same time if you wanted to. But normally you don't need to do that. You can do it with 1 or 2 monitors, and depending on specifically what you're looking at. I love the down touch and the up touch pattern master patterns because as you and think about how you're searching for patterns, you have to have a down touch, so you can always go back and count the identical indicators. Some people will look for the identical indicators and then go look and see if they have the down touches and they have the the proximity group locations and shapes. But I prefer to go to the down touches first to see if there's a down touch, and then verify the identical indicators, and the proximity group patterns. And those, when you're talking about the conditions, remember, you have the requirement conditions that make it a pattern. Then you have, you have the good conditions that make it a great trade for a gap or an uptrend or even a next day up pattern. And then thirdly, you have the extra conditions, or what we refer to as supporting evidence. And if you haven't read the literature, the most powerful method to locate gaps is by locating additional supporting evidence above and beyond the required conditions that create the three pattern, qualifying the three patterns for gaps. So you've got the requirements that make it, the identical indicators, the down touches, and the proximity group, and each one of those needs to be in, you need 12 or more identical indicators in either one or two patterns. You can look at three patterns as well. I've seen 777, three identical indicators, each having 7 identical indicators in each of the three patterns. All three patterns were gap up patterns, or pattern types up patterns. And so 1, 2, or 3 does work, but most of the time you'll see 1 or 2 having 12 or more identical indicators. Then you got the down touches, down touching one of the 6 down touches that qualify. Either the trend red, green, or gray will down touch the trio, the pink, blue, and yellow lines, or those first 3, they're the fast lines, the trend red, green, and gray. They will down touch the 0 line, or they'll down touch under 0, or they will be a sky touch. And and basically the sky touch is not a downward movement, it's an upward movement, but it qualifies as one of what we refer to as a down touch. And there's several days that the sky touch works. The opposite is true in gaps down. In gaps down, you have the exact opposite, the 3 lines being touched, the trend trio lines, yellow, pink, blue, or you have the 0 line, or you have underneath the 0 line. Actually, what it is, it's underneath the blue line, because in down movements, the trend trio is usually underneath 0, so blue is lowest, and then you have the lines in the area underneath the blue line. And the last one, of course, is what we refer to, and rather than the sky touch, we refer to it as a spike touch. And instead of being an up touch, they are days where the lines are going down. It's basically just a continuation pattern that has a gap on the end of it. I hope that wasn't too confusing, but that's how that works. And so how you choose to search for those gaps is up to you, but there's definitely different ways of doing it. And it is amazing. It is, the radar screen just magnifies the reduction of time that's needed to find good opportunities. It is so quick. I mean, you can quickly look at what you can do is you can set up, maybe 1,500 or 15. How many you want. You can set them up in groups of 300 to 500, and you can have 5 or 10 groups, and those 5 groups might be in a dollar price range, like all those stocks between $10 and $45, or whatever range you like to trade in. And so you can have 4 or 5 groups, each having 300 or 400 indicators, and you can grab that group, throw it onto the radar screen, analyze everything. A few minutes later, grab another group, and you can literally examine thousands of opportunities in, less than an hour. So it greatly enhances the ability to find that great deal. Radar screen box color alerts. This was the video on the divergent indicator. There, you can add to it as you see fit. There's more. There's just dozens and dozens of different types of divergence that you can add. But what we have on the indicator right now are the big primary ones that occur with gaps. But don't be afraid to add something else that you find, because some people like to trade in different price stocks, and different things can happen differently in different price ranges as you're trading stocks. So enjoy trading. It is exciting. It is fun. It's profitable, but you need to know how to operate the system. There's a risk involved in trading, and I don't want to make it seem like it's easy. Just jump in and start doing it. You need to understand what the indicators represent. You need to understand why they're moving the way they're going, and that the more that you look at, the more that you examine. Because when you look at an indicator or you look at a stock and you think, do I want to buy this, or do I want to sell it short, or do I want to pass on it? All of that process, that examination, that analysis, all of that activity is the procedure's power. And it's not, the procedure's power is not exclusive to day trading visual basics, but it is a key element that we wanted within the system so that you would build your knowledge and build your information base to understand the relationship between indicators and how price moves based on what you see, both in direction, up and down, in location, above or under 0, or under 20, or above 80, or wherever those particular situations happen to be, and other factors. And so, and by other factors, I mean this one is under 20 and that one is above 35, or whatever those ideas are, that you get that concept. So it's a process of learning. It's a powerful system. It's a very flexible system. It gives different trading styles are very effective in commingling the information to the style that you might have. We encourage you to do things as we've shown you on the videos, and you can obviously branch out and do it any way you want, but get the feeling of how we have done things so far, and then create your own methods and processes to effectively trade how you want to trade. Because in the end, you're going to find a handful of patterns that you prefer trading, and you'll stick with those patterns because what has happened is you've been successful in trading them. You've learned how they react. You see why they move in the way that you do. It may be a case that you're effective at picking the conditions or identifying the specific conditions for the pattern. There's just a variety of things that it could be, but in any case, when you file your trade logs, you're going to look back at that, and this is where the long-term information really comes into play, because all of a sudden you're going to look at it and see, hey, I bought this pattern 35% of the time, and I was very successful at it. And so you can zero in just on buying those patterns, or however you want to treat your trading methods. So it is an amazing system. You can talk about the procedure's power, you can talk about the three-step formula, or you can talk about the fast way on the radar screens with the master indicators that we have to pick up that information really quickly. Whatever it is, we are trying to make this system better each and every day, because we definitely believe it is the most powerful system out there. We don't know of anybody that can find strength in a market movement. I mean, if you can pick out the strength in a market movement and see that it's strong, why would you bother buying a cycle bottom or a cycle top that's just going to move moderately or slowly? Grab the ones that have good volatility. And obviously, the more effective you get at that, the closer you get to really fast changes like gaps. So this is the video on divergence. It is very powerful in the system.